Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 37. Well, the markets have been more than crazy the past couple of weeks with the Ukraine crisis still going on. Just when we think it's going to get better, another shoe drops and our portfolios take a right hook to the face. So we're going to talk about how do we manage this? How do we hold our nose and really believe in the positions that we have? And we're going to go over some of the concepts, some that we've covered before, and just really remind ourselves of kind of the place that we need to be mentally in order to kind of ride this out. So I hope you'll join me. I hope you get your mind right, and let's get to work. Well, the last couple of weeks certainly wouldn't be described as fun in the stock market, right? I apologize. I took a week off, been doing some traveling, New Orleans, Denver. Now I'm back, and so let's get into it. A lot of bad news going on in the market, but I don't want to give you bad news from the get-go. I want to give you some good news, right? So one of the good pieces of news is that Amazon, following in Google's footsteps, announced a 20-for-1 stock split. And they're also going to spend $10 billion buying their own shares back, which the $10 billion, even though it sounds like a huge number, is not really going to impact Amazon stock that much. When you have a company that has a market cap, right? The market cap is the entire value of the company of $1.5 trillion. $10 billion isn't going to move it that much, but it does show that the company's kind of drawing a line in the sand, saying that they think that their stock is maybe undervalued. And so when you look at this, a 20-for-1 stock split, right now Amazon is at $2,910, so $2,910. To make the math easy, let's say when they do their split, it's going to be $3,000 a share. That means the next day you would have, if you had one share of Amazon, you would have 20 shares, and the value would be $150 a piece. So this is very similar to the Google stock split that was announced. Google's stock split is supposed to happen in July, and Amazon's is supposed to happen in June. And so this really is, I can't stress it enough, but stock splits normally are very, very good for the stock, for their performance going forward. And there's a number of reasons for that. I mean, obviously, there's a lot more retail investors that can afford Amazon and Google at $150 a share versus $3,000, right? I mean, that's just the way it is. I mean, if you have a portfolio of $10,000 and you want to buy one share of Amazon, I mean, that's 30% of your portfolio. So not a lot of people can do that or are going to believe in something enough to do that. But there's also a lot of data that backs this up. Since 1980, stock splits tend to outperform the market in general, the market here being the S&P 500. But normally 3 months after a stock split is announced, the stocks are up 7.8%. 6 months later, they're up 13.9%. And then 12 months later, they're up 25.4% versus a market average of 9.1%. And so stock splits, generally are looked on very favorably from the market standpoint. So with that being said, I mean, we have the Ukraine crisis, Russia crisis going on. Obviously, Amazon this past week jumped heavily on that news. They were up about, before that news, they were at 27.84. After the news, they were at 29.43. And they've come down. They finished the end of the week at 29.10. And so there's going to be some bad days ahead, and you might be able to get Amazon for much cheaper than this. And so if you'll notice, the past couple of weeks, Friday is always a terrible day in the market. No trader wants to hold their positions going into the weekend, not knowing what's going to go on with Ukraine and Russia. So, even though the beginning of last week was terrible for the stock market. I believe on Monday, the Dow dropped 800 points, pretty significant. We had a really good rally on Thursday, but then Friday, the last hour of the day, it sells off because traders just don't want to hold into the weekend not knowing what's going to happen or what the news is going to be Monday morning. So you're seeing that pretty much every single week until we can figure out what's going to go on, what's going to happen with the ongoing crisis in the Ukraine. So the reason I titled this episode Hold Your Nose is because sometimes that's exactly what you have to do. And it's not easy for us to do that because mentally, we all hear the investment with the old investment adage, buy low, sell high. But the problem is emotionally, we really want to sell when things are dropping, and then we want to buy them when things are going up because it makes us feel better. And so it's really counterintuitive, right? You have to buy things when you don't want to. And as an investment advisor, I see this. I'll see clients who want to send in money when times are doing great, and then when times are not doing great, they don't want to send in any more money. And it's like that's exactly when you need to do it, right? Sometimes you got to invest when you don't want to. And sometimes you have to think about, okay, the sun's going to rise again one day. The times are going to get better. What out there is presenting an opportunity for me? And so you really have to kind of separate your intellectual mind from your emotional one. And I was reminded of a book. There's a book called The Millionaire Mind. It's by Dr. Thomas Stanley. He's the one, it's kind of more famous for writing the book, The Millionaire Next Door. And but in the book, The Millionaire Mind, it talks about how you have to have courage and that you have to, that if you're going to be wealthy, if you're going to, set yourself up for success, you got to be willing to kind of step into places where other people are not willing to do. And you'll notice that like this year, we've already had a big sell-off in technology. There's a lot of other sectors that have been sold off into, and where are they going? Right? Most of that money is going into oil and gas. But do you want to invest in oil and gas companies when oil's at $110, $120 a barrel? Right? The time to invest in oil and gas would have been when it was minus $30 a barrel 18 months ago, when nobody wanted it. But it's hard to do that, right? It's hard to do that. So right now, if you have oil and gas companies that you've invested in over the past couple of years when oil was out of favor, it doesn't mean you have to sell the whole position. There's something called trading around a position. But if you have oil and gas companies in your portfolio, you can sell off 5%, 10% of the stake that you've made over the past, whatever your profit is over the last couple months. And you can then put that money into positions that haven't done as well. So for example, let's say you own Chevron and it's gone up quite a bit. You could sell, if you had 100 shares of Chevron, you could sell 10 to 15 shares of that. And then you could take that money and put it into Microsoft or Apple or something that's been beat up. You could even put that into, let's say, a Starbucks or a Microsoft. If we want to talk about something that's been really beat up, that has direct exposure to Russia. For example, McDonald's has talked about how shutting down their stores in Russia is going to cost them about $50 million a month. Well, I went and looked and did some math on this, and they've said that McDonald's has said that about 4% of their total sales come from Russia. Well, when you look at this, last year they had sales of $23.2 billion, right? So 4% of that is about $900 million. Well, before the start of this Russia-Ukraine crisis, the market cap, the market value, the entire value of McDonald's was at $190 billion. Well, now, as you move on to today, the drop in McDonald's from $256 a share back down to, let's see where it is today, $227 with a market cap of $168 billion. That exposure to Russia has caused investors to sell off McDonald's to basically the tune of a $22 billion drop. So a market cap of $190 billion down to $168 billion is a difference of $22 billion. So on a country that has sales exposure of $900 million a year. Well, to me, I look at that and say, okay, McDonald's is a position that I own personally. I should put that out there, full disclosure. But I look at that and go, man, the next time I get paid, I'm going to scoop up some McDonald's because I think that that's a little bit overdone, right? I mean, selling them off $22 billion, dropping their market cap $22 billion because they have exposure of $900 million a year. And that's kind of how I look at this, right? So, you have to be willing to, walk into the fire a little bit and say, do I really believe in these companies? And do I think that there's going to be some kind of solution that is going to end kind of this turmoil? And that's really the key to it. I mean, who knows? I mean, I don't know if it's going to end next week, a month from now, 6 months from now. Is it going to escalate into something that's going to be bigger with more nations involved? Hopefully not. But those are the things that you have to consider when making these kind of decisions for yourself. And something else to consider, earlier on in one of the earlier episodes, I talked about designing your portfolio, right? Thinking about the things that you want to buy more of or the positions that you want to hold for yourself personally. I mean, this is the perfect time when you should know, okay, the next time I get paid, I'm going to buy a share of this or part of that. Like, you should kind of have it laid out. And you should be thinking, okay, man, I hope the market maybe stays low so I can buy more of this when I do get paid. But you also have to consider, when you're looking at when you're in this kind of environment, you can't just look at the market all the time, right? So one of the investment biases we've discussed before that I think is worth reminding you of is myopic risk aversion, which states the more often you look at your portfolio, the riskier it becomes. And that's because you're seeing all the ups and downs. And especially if you're looking over the past couple of weeks, I mean, everybody's starting to throw up in the trash can a little bit, because when you're going up 800, down 800, up 600, down 500, I mean, it really does start to be a little bit nauseating. So, you at this point, you got to be able to, click the button, invest some money, and then be willing to walk away and kind of, just not look at it for a while, right? And say, okay, I'm going to invest in these companies and I'm going to stick with it. And I'm not gonna check it every hour of every day, because it does get quite painful. And you can, change the channel to ESPN or something, watch March Madness, and don't worry about it for a little bit, because at the end of the day, if you invest in good companies, you're going to, more often than not, you're going to be able to prevail. So I just want to double back on that idea. Kind of got sidetracked with McDonald's there, but about trading around a core position. So within your portfolio, you should have positions that you consider core holdings of things that you know that you're going to hold for the foreseeable future. And, don't get sidetracked into thinking if you sell a little bit of it, you have to sell all of it, right? But there are times where the value of the things you hold on some of your things, if you have a diversified portfolio, I mean, this isn't going to work if you have all technology stocks, but if you have a diversified portfolio and right now you own some oil and gas stocks, you can trim those a little bit and put that into other core holdings that are down. And vice versa, when technology was really big and oil was minus $30 a barrel for a little bit, you should have trimmed a little bit of your technology stocks and put it into some of those oil and gas stocks. And that really is portfolio management. That is trading around core positions that you know you want to own, and you're trying to take advantage when something is at a higher level versus when something's at a lower level. I think that one of the things that you have to be wary about right now are all the investors that are chasing oil companies and gold and all the things that are safe because of what's going on in the news today. And you really do have to be, wary of chasing returns when it now looks like oil and gas is the greatest investment ever, defense stocks, which, full disclosure, like, I'm a big time believer in Lockheed Martin. I've owned that for myself and for our clients for a number of years. It's always been a core holding of mine. But now, obviously, with the risk of World War III or whatever we're discussing, these stocks have run up. And so you have to be diligent and you have to be able to trim when things look so great for those kind of companies and so grim for other kinds of companies. I mean, that is what disciplined portfolio management is all about. And so you got to keep your wits about you when you're looking at doing this. But trading around a position is a very good way to kind of pair that with the buy and hold mentality, where you're just looking to take advantage of kind of the news cycle and things that are out there, because investors do become so emotional. And not saying that we're trying to profit off of that, but knowing that investors are going to be emotional, it allows you to be able to kind of take it, to try kind of improve your chances when that happens. So one of the last things I want to discuss today is inflation. So you've been seeing all the news coming out, CPI, which stands for Consumer Price Index, 40-year high, right? We've discussed this before, but this week on March 16th, in the next couple of days, Jerome Powell, the Fed, are going to meet, and there's a 96% chance, the market thinks a 96% chance that they're going to raise interest rates to 0.25 basis points, which needs to be done. Some would argue that it needs to be higher than that. But I think this first round that they'll do 0.25 basis points, right? With all the uncertainty going on globally, geopolitically, we'll see what happens. But inflation does need to be talked about because it is going to impact. So we just discussed high oil prices. And what does that impact? Well, it impacts a lot of things, right? I mean, if you want to go look at airline stocks, go look and see how these high oil prices have impacted oil stocks, right? So over the past month, you've had, Southwest Airlines, Delta, all of these just kind of get really beat up. And honestly, Southwest Airlines this week got close to trading almost as low as it was back in the COVID-19 of May 2020. I think this past week it got down to, what was it, $36 a share, $37 a share. And back during March of 2020, it was at 34. So, I mean, really come off of its highs. It went up as high as $62. So, some of these airline stocks, I'm starting to look at them going, well, that looks interesting. But what does, higher oil prices, how does that impact the economy? Well, it impacts obviously directly with airlines. That one's pretty easy to figure out. But when people are paying more at the pump, that leaves them less income to do other things with, right? Travel, obviously. So airfare, hotels, theme parks. But it also, depending on how long it lasts, impacts their ability to be able to buy food and clothing and all of these things. So, that'll be something that we'll have to watch. I mean, high oil prices are not great for everybody. For a small segment of the population, obviously, it's good for them, but for the greater population, it definitely hurts. And so, what's interesting is I think the highest oil prices. I didn't look this up. I'm going off of memory here, but I think the highest oil prices have been was like Brent crude hit $145 a barrel back in 2008. And I think 6 to 9 months later, it was at 45. So, these high oil prices can go up really quick and they can come down really quick. And that's why I said earlier in the podcast, like, be careful of chasing. I mean, if you added a bunch of oil positions over the past couple weeks, make sure you're using some kind of stop or something something to protect yourself. Because if somehow we had some kind of resolution in Russia and the Ukraine, I mean, oil prices are going to drop by $20 a barrel overnight if that were to get worked out. So I don't know. It's just a tricky situation, but you just you got to protect yourself and seeing how this goes. But the inflation thing is not going to go away for a while. Obviously, with the Fed meeting this week, discussing this, seeing how, the 25 basis point move, how that impacts this. They're also stopping their asset buying, which the Fed has been buying assets in the stock market and the bond market. So you're going to have them as a buyer go away. So there doesn't look like there's going to be an end to the volatility that we've seen. There's not going to be a quick resolution to that as we move forward. It's probably going to be bumpy for a while, and 2022 could be a pretty rocky year unless something crazy happens, which it could. But it looks like there's still going to be some volatility in our future. And so with that being said, make sure when you're adding to the positions that you have, you're starting to build up your portfolio, you give yourself the ability to buy more if the stocks that you're buying start to go down even more, right? So, start looking for price points. Apple, for example, it's one we talk about, which is why I keep mentioning it. It's at 154. Well, if it drops to 148, be willing to buy a couple shares, right? Don't try to be a hero and buy everything all at once and not leave yourself the position, the ability to buy a little bit more. And so you just have to remain disciplined because you never know what could happen. You don't know what the next day could bring. And so you have to be careful. With all this being said, I have to remind you, this is for entertainment purposes only. I'm not your financial advisor. Please consult your financial advisor before making any investment decisions. Past performance is not indicative of future results. So always forget to get that in here every single time. You'd think by now that I would remember to do that in the beginning, but that's just not the way it goes. So a couple reminders as we wrap this up. Remember to stay disciplined. Remember to stick to your plan. Remember to invest even when times don't look as good, right? Make sure that you are committing to investing for your future. That think about what the companies that you're investing in are going to look like 3 years from now, 5 years from now, 10 years from now. You're designing your life 5-10 years from now, not 5 to 10 days. So you got to stay disciplined, and you got to remove the emotion, and you got to commit to something, right? You got to believe in something. So you better believe in that your future is going to be better than it is right now if you stay disciplined, you stick to your habits, and you stay optimistic. So even when times are bad, we gotta stay disciplined, and we gotta stay optimistic. So I hope this helps you. I appreciate you taking the time to listen to this, and let's get going, man. Let's get back to work, and I'll see you next time.